All right, let's talk about intraday trading. We're going to cut through all the usual noise and focus on a super simple rule-based strategy, inspired by the work of trader Mukul Chaudhary. So if you're looking for a way to bring some real discipline and clarity to your trades, you are in the right place. Let's dive in.
You know that feeling, right? Staring at thousands of stocks, endless charts, and a flood of data? It's that pit in your stomach from total information overload. It's so easy to just get lost, confused, and end up making inconsistent, frankly, bad decisions.
But what if you could just filter all of that out? Well, that's exactly what we're going to do here. We're going to show you a simple, actionable strategy that uses just 2 core indicators. That's it. This is all about going from confusion to confidence by following a very clear set of rules.
So what is the biggest challenge, the real dilemma for a day trader? Honestly, it's not just about reading the charts. It's about knowing which of the thousands of charts you should even be looking at, and then when to actually do something. This chart just hits the nail on the head, doesn't it? Look at that huge slice for information overload. It's the root of the problem. And you can see how it leads directly to the other issues, no clear signals, and of course, inconsistent results. It just goes to show, more data doesn't mean better decisions. A lot of the time, it just means you freeze.
So to fix this, we're going to radically simplify our toolkit. The entire foundation of this strategy, everything we're about to talk about, rests on just 2 indicators. Seriously, that's it. Nothing else needed.
Okay, first up, exponential moving averages. You'll hear them called EMAs. We're just going to use the 10 and the 20. These give us a quick and easy way to see the short-term trend. Second, and this is the really crucial part, we're going to use Camarilla Pivots. These are what we'll use to define our playing field for the day.
So what in the world are Camarilla Pivots? The easiest way to think about them is like a boundary box for the day's price. They automatically calculate key support and resistance levels. Now for this strategy, we only care about the outer edges of that box. The resistance levels R3 and R4, and the support levels S3 and S4.
And this brings us to what is, without a doubt, the single most important rule in this entire system. This rule, all by itself, is going to tell you whether you should be actively hunting for trades or just sitting on your hands and being patient.
So here's the core idea, and it's super simple. If the price is trading inside the R3 and S3 pivots, we consider that a sideways, choppy market. That is our no-action zone. Moving averages don't work well here, and trades are just likely to fail. But the moment the price breaks outside that box, everything changes. We are now in the opportunity zone. That's our signal that we might be in a trending market with the potential for a really big move.
Okay, so we know when to be on high alert. But wouldn't it be great if we could anticipate these big moves before they even get started? Well, the strategy actually has a predictive element built right into it. Let me show you how it works.
See, the key isn't just looking at today's chart all by itself. The real clue, the secret for what might happen today, is actually found by looking back and seeing what the price did yesterday.
And this quote just sums up the whole concept perfectly. Markets are always moving between quiet periods and explosive periods. A quiet day, where the price is all compressed into a narrow little range, well, that's like a spring coiling up, getting ready for a huge move.
This chart makes it totally clear. What we're doing is we are actively hunting for stocks that had a narrow Camarilla range yesterday. If the range was wide yesterday, a big trend today is less likely. But if that range was narrow, that gives us a high probability setup that we can watch for today.
So we've done our homework. We've found a stock that was quiet yesterday, and today it's starting to break out of its range. Now comes the most important part, executing the perfect entry. This is not about just jumping in whenever. It's a disciplined, step-by-step process. Okay, listen close, because this is critical. First, we identify a clear breakout past R3 or S3, but, and this is the absolute key, we do not chase the price. Step 2 is to be patient and wait for the price to pull back and test our 10 and 20 EMA zone. And only after it touches those EMAs and confirms it's moving back in the breakout direction, only then do we enter. That patience is what separates a great entry from an emotional one.
And of course, we've got to manage our risk. The rule for that is just as simple. If you're buying, your stop loss goes just below the 20 EMA. If you're shorting, it goes just above it. This keeps your risk small and connects it directly to the trend.
All right, we've gone over the tools, the logic, and how to execute. So let's put it all together into one final, actionable checklist that you can use every single morning before you even think about placing a trade. Here it is. Before every single trade, you just run through this list. Did it have a narrow range yesterday? Check. Has it broken out today? Check.
Did I wait for that pullback to the EMAs? Super important. Is my entry confirmed? And is my stop loss set? And finally, am I trading inside that optimal window of 9:15 a.m. to 1 p.m.? That last rule is crucial for staying out of that unpredictable afternoon mess.
Just one final tip on picking your stocks. This strategy really shines on liquid, large-cap stocks. Why? Well, because they tend to have cleaner, more sustained moves. If you try this on some small, choppy stock, you just won't get the momentum you need. So it's best to stick to a fixed watch list of quality companies.
And how many trades are we looking for? Remember, the goal here is not volume, it's quality. You should be aiming for a maximum of 2 excellent setups per day. That's it. This kind of discipline protects your money and forces you to wait for only the absolute best opportunities.
So I think the real takeaway here is the incredible power of simplicity. In a field that's just dominated by complexity and emotion, maybe the most effective thing you can do is just follow a clear, simple, almost mechanical set of rules. Which leaves us with a final question to think about. Could this be the key to finally removing emotion and unlocking your own consistency?